3 secrets of stock market investing that are ruining people's return. If you get these 3 things, it would be so much more fun and easier for you to invest in stocks. Let's dive in. A little background. Who am I? I'm Bejle Grünbaum. I've been teaching value investing, which is a kind of stock picking, for 8 years. I've realized that it's so hard for people. Only around 1% get it. The rest, 99%, they're doing it really wrong and they're ruining their own returns. Why? Well, this is what these 3 secrets is about. The first one is you can actually time the market. People say you can't time the market. And on one hand, they're right. You don't know exactly when something is happening, but you do know that it will happen sooner or later. What do I mean? Well, the stock market is like the seasons. You've got winter, you've got summer. So you can say it's winter, it's going to snow. You can't say on the 23rd of December, it's going to snow, so we'll definitely have a white Christmas. You can never promise anyone that, right? We know that. But you do know it will snow, at least if you're in Denmark, where I'm from. At some point, it will snow. It's the same on the market. If we look at the data, we can pretty much tell what's going to happen in this season. We can never put a specific date on it. Now look at this, for example. This is Warren Buffett, one of the world's best stock market investors, cash pile. When I say cash pile, obviously it's not physical cash. He's not swimming around in it like Scrooge McDuck. It's invested in short-term bonds, T-bills. But look at it. Do you notice that he's holding an incredible amount of cash right now? On $350 billion. That's a lot. What does Warren Buffett see? Well, actually, he's just looking at the data. He's looking at the companies. Are there any companies that he would like to invest in for the price they are trading at the stock market? That's all he's looking at. He might glance at different indicators. For example, Schiller's PE ratio, which shows you the PE, which is price earnings, something you can calculate for any company, of the US stock market. It is historically high right now, meaning that the stock market is in bubble territory. He might look at other things like the Buffett indicator. But the end of the day, for Warren Buffett, it's just a question, is there anything I'd like to buy for the price that it's trading at right now? And that's data. Did you know that Schiller's PE ratio right now is above 40? In 1929, it was just above 30. So it's at a much higher level. This is a much bigger bubble than in 1929. Think about that. Isn't that scary? That's data. So this means while you can't exactly tell what time or date something's going to happen, you know we're in the season for something. We are in that season, my dear. We are in winter. Winter's coming. Does that mean you can't invest right now? Of course not. If you find a wonderful company, meaning a company that is very good at what it does, has a good management, wonderful product, and can protect itself against competition, and that is reasonably priced, and you can calculate that stuff, you can still invest. And yes, there are actually whole sectors that are down there where it's investable. Secret number 2, it is not risky to invest in stocks. People say, oh, it's so risky, there'll be a stock market crash. And yes, stock markets have crashes. Yes, stocks can dive. It happens. But that's not what makes it risky. It's your emotional reaction that makes it risky. Let me show you. Which investment do you think is better? Stock A, that goes up steadily, or stock B, that falls but goes back up? Stock A goes from 100 to 110 to 120 to 130, 140, 150. Nothing moves like that in the real world, but that is what people want. People who do not understand the stock market, that's their dream scenario. And then you have stock B. It's at 100, goes to 60, 40, all the way down to 15 and back up over some years. You can plot this into chat and ask it. If I invested the same amount for 1,000, it doesn't matter which currency, let's just say, USD, how many shares would you get? And what would it be worth at the end? And takes a few seconds, ChatGPT will calculate it for you and tell you that that's a return of 22%. Alrighty then, what about the other case? a little moment, ChatGPT will tell you it's a return of 169. Now, we've invested exactly the same in both cases. So that the stocks drop was actually an excellent thing as long as we believe that will go back up. And when we invest like that, we have to invest in companies that we have really researched, that we believe in. Now, what if instead of investing the same amount, you developed a system where you invest even more when the stock drops? So in this case, in year one, we're investing just 500, and drops, we'll invest 750, and then 1,000, 1,250, 2,000 when it's at 15, and then back up, we'll invest 500. Which kind of return would that give us? I asked ChatGPT, and a moment later, the result was there, and it said 271. That's a very nice return, don't you think? Well, the problem is that people don't react like that. They react like this. 95% of people react like this when stocks drop. This is an actual stock from the financial crisis. I was in the market, and it is not fun to see your investments go down 50, 60%. That's what happened with my retirement account. But look at this specific stock. This is what happened. Where you see the arrow, that is the financial crisis. And it went up again. That looks nice, doesn't it? But wait, there's so much more. It went up a lot more. This looks nice, doesn't it? But wait, there's even more. It went up that much. And if you had invested in this particular company, which happens to be a Danish company called DSV, if you had invested 10,000, that would have turned into 3.5 million. If you had invested 100,000, that would have turned into 35 million. Now, that's a specific example, just to illustrate that the problem is that people get too freaked out. You have to remind yourself again and again that when stocks drop, it's actually a good thing if you know what you're investing in. And if you are chill about it, if you're cool about it and have the guts to invest more. You might be asking, what did I do during the financial crisis? I invested more. I felt all the emotions, everything. I thought it was quite uncomfortable, but I thought this is exactly the time to invest. And I invested as much as I could at the time. So crashes are nothing to be scared of, really. It is your own emotional reaction that you have to respect. You might ask, so how do I overcome that? Data. Look at the data. Just look at the data. Remind yourself that it's a good thing. Look at that chart again that I showed you. Maybe you want to rewatch this video to be reminded. The third secret is that it's simple to invest. People say, oh, but it's so difficult. I'm not that good at math. I'm not that good with money. The misconception is that people think you have to have a really high IQ and be really special to invest. And no, that's not it. Because what makes it difficult? So it's simple, but it's not easy. It's simple, but it's difficult. And what makes it difficult are your emotions. But if you build a system where you're looking at the data, at facts, it becomes really easy. The problem is that most people don't have such a system. Do you remember Liberation Day when Trump went out and said tariffs here, there, and everywhere? A few days after, I was taking a walk with my dog, which I do every day, and I met one of the other parents. And I asked them, like you do when you meet another dog walker, how are you? And I'm fine, how are you? But this time the conversation didn't go like that. It went like this, how are you? And he went, oh, the stock market. And I asked what happened. And of course, we talked a little bit about the news. And he told me he had sold all his Apple shares. Well, Apple went up after that again. So he had bought them at the top and sold with a loss. Let me tell you a secret about me. I have Apple shares. I've had them since 19, I've had them since forever. And they've gone up and up, sometimes a little bit back and then up and up again. I'm just keeping them. And there has to be a really huge change in the story before I sell them. They would have to drop a lot, like a lot. I mean, they'll never drop that much. So the trick is to have a system. I'm talking a lot about this for the time being because I'm launching the Wealth Builder system, which is a system I'm building that will give you exactly the data that you need. And we're building a portfolio like a very solid structure with a thick bottom, like a pyramid. So solid things in the bottom. That would be funds in the bottom, ETFs, and then different kind of companies. And I've developed a system where I categorize these companies because companies are very different from one another. They're just as different as people are. You can sort them into groups and build this pyramid. And how do you know when to invest more? Well, I've developed another thing, which is like a traffic light system. So you can turn up the volume of your investment and turn it down when things are too expensive. I've launched it in Danish. I didn't launch it in English yet, but it is coming. It is a super simple way to invest that takes all the speculation out of it. So stay tuned. It is coming to a cinema near you too. That's what I had for today. Now, go watch another video.